Today, we are extremely happy to be joined by the largest asset management company in the world, BlackRock, and the largest mutual fund provider in the Philippines, BPI Investment Management. For the longest time, investing in global assets has been out of reach for many Filipinos. But now, we have a way to access them through what we call feeder funds. So this afternoon, we will have a very exciting discussion as we learn more about global investing and the newest fund in our platform, the ALFM Global Multi-Asset Income Fund, which will allow you to earn regular income through its global exposure. Let me call on the Director and Product Strategist at BlackRock, Mr. Bevevino, to give us a color on what is happening in the global markets and tell us more about what a multi-asset investment strategy is.
Thanks for everyone for having me. It's certainly great to be back here, and I appreciate everyone taking time out of their day to hear from us. As Mark mentioned, I'm a product strategist for BlackRock, the world's largest asset manager, working in our multi-asset group. So I have about 15 minutes today, and we wanted to share both a little bit of an outlook around our strategy, as well as a bit of an overview on what's going on in markets. And so to start, we'll jump right into talking a bit about the backdrop first and what are kind of the big driving forces in markets. And I think it's helpful to first just take a kind of big picture look at the world, because obviously a lot's gone on over the course of the last 18 to 12 months, 12 to 18 months. And, we're still very much dealing with a little bit of a pandemic across the globe. And if we just take a step back, though, and think about what are the things that have been driving markets, the things that have been driving markets, we still think are in place today, but ultimately they are slightly softer than they were at the beginning of the year. And so to lay these out kind of very clearly as to what are the things that have been working well for markets, the first thing I would say is we still are in an environment where financial conditions are incredibly accommodative. So what do I mean by that? I mean, central banks and governments are still doing a lot to help contribute to the economic rebound that we're seeing on a global basis. That's still an important element of where we are today and what we think will continue to drive markets forward. This has evolved in the last couple of months with some of the central banks, but still very much supportive. The second point that I would note is vaccinations have proven effective. And even though we've seen an increase in waves lately, we are encouraged by the rate of decline that we've seen on a global basis within the last couple of weeks. And we think that can persist. And that's an important thing to take into consideration when thinking about the global outlook here. The last part of this is that growth levels ultimately still look really healthy, even though that they've come down, and we expect that to persist throughout the course of the remainder of this year and into 2022. And we do think that sets a backdrop up that supports our base case, which is one that we think global stocks can continue to move up. And we also see interest rates in developed markets also moving up, which has implications for investors that are in bonds, which we will talk about. But we do see a bit more volatility ahead. And I think this is an important point, and certainly one that you saw play out in the month of September for, I think, a couple of reasons. One was certainly related to what we're seeing happening in China. Some was related to the central banks that we just mentioned. But September is seasonally a very weak month. And just a quick stat on this, because I think it's really interesting. There's actually only ever been 2 months since 1945 that have an average stock return that's negative for U.S. equities. That's February and September, with the latter being the worst. So historically, September is a very tough month for markets. We saw that play out again in September. But ultimately, we think we're still in an environment where risky assets, things like stocks and higher yielding corporate bonds, can do well. But just to dive a little bit deeper into these views real quickly, If we could reference the first slide that's titled "The Delta Variant Stirring Up Fears." You could see a couple things here. The first thing I would note is we're showing the COVID cases, deaths, and cases in the U.S. and in Europe. And big picture here, we saw a very big wave earlier in the year. We've seen a recent wave within the last couple of months, but importantly, we're actually now seeing an inflection point, and we're actually starting to see that come down. And this is actually an encouraging trend. If we look at the U.S., declining cases are happening in 41 out of 50 states. You're seeing a similar thing in Europe as well. And so we think that it can continue. And the reason that that's obviously really important is because that's going to allow economic activity to continue to rebound here. We have seen a little bit of a slowdown in economic activity, but ultimately, we think the virus can be contained because of the vaccinations have been proven effective, and that's going to allow economies to continue to reopen. And I would just note that these waves, as we've seen because of the vaccination, even if we continue to have those, we expect them to be, the peaks of those waves to be lower than we've seen in previous trends. If you jump to the next slide titled Backdrop Still Supportive of Risk Assets, as I mentioned earlier on, there's kind of two main factors that have been supporting things like global stocks. One is the level of growth that we've seen in markets. You can see this on the left-hand side of the page. And the second is on the right-hand side of the page, where we've seen a lot of stimulus come into the markets from central banks. We ultimately think both of those things are still in play. But as you can see on the left-hand side of this chart, GDP levels, if we look at China, the US, and Europe, are expected to come down. And as I mentioned earlier on, I think it's important to note that it is still very healthy levels, and that should be supportive of the backdrop. The second point here, which is related, is liquidity. You could think about how much cash is getting put into the system from central banks. Here we're using the US because they've been the most significant contributor of this, the Federal Reserve in particular, who is the central bank of the US. They've really put a lot of effort into stimulating the economy over the course of the last 12 to 18 months. You could see that in the money supply in yellow. And then if you look at the red line, which is showing you the change, you can see that that's actually come down. And the Fed is actually now in a position where we think the economy is healthy enough that they're going to remove some of these emergency accommodations. And inevitably, that's going to create a little bit of market volatility. I think you saw that play out in the month of September. But ultimately, we do think markets can digest this because they're healthy enough from an economic growth standpoint. And we don't actually think it's necessary to have kind of these emergency measures in place. And so the point that I would make on kind of these slides is that the virus has created a little bit of volatility because we've seen increase in waves. We're starting to see an inflection point in that moving lower. The second point that I would note is that growth still looks relatively strong, even if it is coming down. And we're still in an accommodative stance from most central banks and governments, although this has changed a little bit, which we think will contribute to a bit more of a volatile backdrop. So we think it's important for investors to pay close attention to how much risk they're taking inside of their portfolios. If you jump to the next slide titled Most Markets are no longer cheap, this is a chart showing you several different markets across the globe, and they're ranking them by their own respective histories to show how expensive they are relative to their own histories. So you could see, if I just look at the first asset class, that's US TIPS, which is an inflation bond. You could see that it is trading right now at its most expensive level ever. So on the left-hand side, you see fixed income. On the right-hand side, you see equities. And the point that I would make here is that a lot of markets have really recovered over the course of the last year or so. And most areas now are no longer cheap, but we ultimately think there are still some areas that will be supported in the market. So just to highlight a few here, if you look at the kind of middle part of the bond part of the fixed income part, areas like US high yield, European high yield, emerging market debt, all of those areas still look reasonable to us when we think about where they're trading today. And you could see that in purple there is their currently where they are. And we think they'll be supported by the backdrop, which is still one where you're seeing pretty strong economic activity, still good earnings growth. But we are pretty cautious on the areas right to the left of that of like government bonds. We don't think there's a lot of value there when you factor in the threat of rising interest rates and inflation. And on the right-hand side of the page, in terms of equities, we still think there's room to go in equity markets. We've been favoring the US, and in particular, we've been really favoring kind of quality stocks. So think of stocks that have good, consistent earnings, low debt levels, have the ability to pass on price pressures. Those are the kind of stocks we think investors should be owning in this environment, not the stocks that are the most sensitive to economic activity. Things like really deep value stocks is a term you may have been familiar with, or growth stocks that don't really have a lot of earnings right today. We don't think those are the areas of markets that investors should focus on. Just in the interest of time, just moving on, if you go to the next slide, I think this will tee up kind of our strategy, global multi-asset income that we run. There's one thing of note from our standpoint that it continues to strike us is there's just a tremendous amount of cash that still exists on the sidelines for global investors. So if you see the slide titled "Massive Sums of Money Sit in Assets That Will Struggle to Earn a Positive Real Return," and when we say real return, we mean a return in excess of the level of inflation today. And so you can see on the right-hand side that still there's a huge amount of money that sits in cash funds today. And those are areas of the markets that aren't going to have a very high return to them because interest rates are so low today. And part of interest rates being so low today is because of the function of what central banks have done to stimulate their economies. We ultimately see that persisting for the next several years, which means if you're in really conservative assets like cash or even some of the bond markets, it's going to be hard to generate a compelling income or return there. And that ultimately is why we have developed and continue to support and promote our global multi-asset income strategy as an alternative to some of these, as a way for investors to get diversification and some income, recognizing that a lot of the traditional means that investors have relied upon are no longer as compelling as they once were. So just in the interest of time, I'm going to skip the next slide, and I could certainly come back to some of the summary points around the outlook through Q&A. But I want to spend just on the next couple of minutes going through our approach to multi-asset income investing and what we think are the important things for investors to consider today. So if you jump to the slide titled "The Universe for Yield Has Shrunk," I think this is, one of the most telling slides in all of capital markets, and because it has such an important ramification for what investors are doing globally, what companies are doing globally. And it's just the direction of interest rates over the last 2 decades. They've collapsed on a lot of global bond markets. And so what we're showing you on this slide is a number of different fixed income or bond markets on the right-hand side of the page. And then on the left-hand side of the page, you'll see that it shows the percent of these markets that have a yield above 4%. So the way to read this is if you go back to 1999, virtually every single one of these markets, and the bar size represents the size of those markets, but virtually every single one of these markets had a yield in excess of 4%. And then you fast forward to today, and there's really only one bond market that has a yield above 4%, and that's global high yield bonds. And so for investors that are just trying to access the fixed income universe or the bond universe to generate income, today it's a lot harder to do that because the opportunity set is so constrained because interest rates have come down so much. And as I mentioned, that's definitely a function of what central banks have been doing globally, not just in the last year, but really since the start of 2008 and 2009. So this is one part of the story here. The next part of the story is what I think really goes into how we think about managing a globally diversified income-oriented portfolio, which you could see on the next slide titled "Expanding the Opportunity Set," where we are very much of the belief that no single market solves the challenge today, that investors are better off having some diversification in their portfolio. So not just owning, say, US treasuries or emerging market debt, but rather diversifying across all of these different markets. But the reason to do that, I think, is twofold. One, because it allows you to expand your opportunity set to find more compelling income and return. But two, it also allows you to diversify your portfolio to help manage risks. And I think on this slide here, you could really see the importance of doing that. So what we're showing you on this slide is, if you look, the average yield is shown above the axis on a number of different markets. So you could see kind of the higher yielding markets that exist globally. But below the line shows you the average annual drawdown. So this is the most that these asset classes have lost from it during a sell-off over the last several years, and it's taking an average of those. So really what you could see is that there is really no one market that gets you a lot of income and downside protection, but you can piece these things together to get some diversification where you get a compelling combination of both income and some risk management and downside protection. But for investors, we think it's really important not just to focus on yield alone, but think about yield through the lens of risk as well. Because when you expand the opportunity set, you also introduce new risks, and you have to think about managing that inside a global multi-asset portfolio. The last point that I would make is, in addition to expanding the opportunity set, if you jump to the next slide, you can see that it titled Income Asset Classes Regularly Change Leadership. And what we're showing you here is a number of these markets that we've discussed. So things like emerging market debt and REITs, going back to 2020 and showing their ranking in terms of the best performer in that year and then the worst performer on the bottom, and then goes through each calendar year. And the simple story here is that these things change a lot. And so we think this underscores two simple points. One, investors should be diversified because there's not one thing that wins in every single year. And two, having some flexibility is important, and not being strategic in the way that you think about your asset allocation, or super rigid in the way that you think about your asset allocation, but rather having some flexibility to take advantage of some of these changes in markets to both protect and help manage risk, but also take advantage of some new opportunities. So I want to be respectful of other folks that have a time on this call. I did want to just kind of summarize as to why I think, if for investors that are thinking about investing in multi-asset income or global multi-asset income, why is it really relevant today? And just to kind of hit on this in three main points, I would say the first is global multi-asset income was ultimately designed to provide higher income and more upside potential relative to then what's available in most bond markets today. As I mentioned, interest rates continue to be incredibly low. Even if they move up a little bit, we expect them to be incredibly low for the future. The second would be, investors have gotten very concentrated during the pandemic. And so global multi-asset portfolios are a very easy way to get exposure and diversification to a wide pool of income markets, which can help manage risk and volatility. And then the last point I would make is, markets are ultimately changing pretty rapidly. I think you're seeing that play out real time. So having a degree of flexibility is also really important. And those are the points that ultimately sit at the core of how we think about running our portfolio. So I want to stop there. I don't believe I've been able to get my video to work, so I apologize about that. I will try to get it back on for the Q&A session. But with that, let me pass it back over to the moderator.
Yeah, thank you very much, Zach. So if I got it right from your talk, aside from the key points that you mentioned, it seems that the significant returns that we've seen the past 18 months may be hard to replicate anymore, especially with factors like inflation, the Delta variant risk, and perhaps the more modest central bank policy backdrop. But clearly, as you mentioned, there are still pockets of opportunities. That is why diversification is important.